Hello, everybody. Hi. So let's wait a few minutes. I think some people will not be able to join today. I don't know exactly how many of us will be on the meeting, so I think we can still wait a few minutes and see. Hopefully we can reach 5 to 10 people, and then we can start. I've shared with you, maybe I can share the screen already. So you can find I guess all of you have access to the teaching material website. I have downloaded and I've taken some notes and highlighted certain parts, and I shared a link with you today, so you can find it. There was an email sent earlier today, and you can find the updated material on through the link uploaded on my Google Drive. So as I said, the plan for today, hopefully we can cover the lectures, the PDF material. And let's wait. I guess more people are coming. So right now we're 4 people. Okay, I think we can go through the introduction, because I think everybody is familiar with the content of the course. Yes, so while we're waiting for more students, we can have a quick look. I don't know much about this program. Is this your first exam you're taking, or sorry, the first course or the second one? I think there was a research methodology before.
Yeah, research methodology, and some of us were in the Agile project course as well.
So this is probably the second or the third one.
Yeah.
And I had a look at CV and resumes. Some of you don't have an economic or finance background. A lot of people have done computer science or engineering at university, but that's not a problem. This is a pretty straightforward course. Usually it's called monetary economics, and in this or monetary financial economics. In this case, it's called financial economy. But it's a pretty standard syllabus. So we will cover supply and demand of money. What is the definition of money, of course? Why do we have money? What is the purpose in modern economies? And then we will talk about central banks and the policies they can adopt. And then in the end, there is a little bit about foreign exchange. And in the next lecture, we'll talk about cryptocurrencies and central banks policy in details. We have a couple of readings besides the PDFs provided by the instructor of the course. So for today, as I said, I want to cover basically the introduction and the 5 main topics, which is money, money market, money supply, demand, monetary policy, financial crisis, and Forex. Okay, now. Let's wait a few more minutes. So there is a final assignment for this course, and the deadline will be later in November. There are also some practical questions. So the third meetings, which is in 2 weeks, we can try to address this mock exam, which has pretty much the same structure assignment. And we also have some practical questions as well. 5 students right now. Still 5 students. Let's wait a few minutes and then we can start. I think until perhaps 7:15. And if you have any questions, we can really start to discuss, or if you want to ask me anything. I will wait a little bit more before starting formal introduction of the course and the plan for these lessons.
Can I ask a question?
Yeah, sure.
Yes, because I saw your background is about management science and quantitative economics. And because we just started to write about the dissertations, so I just want to ask about, because there is a formulation, like you have to use the mathematical to do it. So how you do that? Do you need some, like, can you also ask somebody to do the mathematic formulas, or you really just research it all by yourself?
You mean, okay, in my research, okay. Usually I do it by myself, but in the past I also, I mean, actually I'm writing a couple of papers with some other students in different fields where I'm not strong. So usually what happens in research, if you have a set of skills and that are needed to carry on the research, and some of them you're not capable in some of the aspects of the research, you can team up with a colleague, or oftentimes people on the other side of the world. So yeah, usually you shouldn't waste, let's say, waste time to learn something during the research process. Let's say the government gives you a grant, you're expected to have a team, or at least a set of skills that is enough to carry on the research. So if you stumble into a problem, the best idea, instead of go and learn it by yourself, is to ask for help as a PhD student through your supervisor, and then usually he or she put in touch with someone first in your department, and later when you're a bit more expert, you go to conferences and meet people. So yes, if you have a problem with the formula, you can, which is, would be too much waste of time, try to learn the linear algebra that is needed, for instance, you can find someone else to help you, like a co-author or second author, and so on.
Okay.
I think now we have 7 students. Yes, and I think we can start in a minute, otherwise. Yes, perhaps I can quickly go through my CV. I think you have received my CV already by mail. There's nothing much to say. I'm just completing my PhD at City University in Hong Kong, and my field of study is empirical asset pricing, which is one of the 2 branches of academic finance. One is corporate finance, and the other one is asset pricing. And I've been teaching assistant, part-time research in the past, and I've studied economics, bachelor and master's degree in economics and finance. And I have 4 years experience as a financial analyst in Italy. And I recommend, as a personal advice, I recommend you, if you already don't know it, try to learn a programming language, perhaps Python, which is really helpful, either in terms of productivity, but also to carry on research. And I've seen some of you have uploaded the CVs. As I said before, this course it's in economics, so financial economics, monetary economics. There are different names to call this subject, and it's quite easy in the sense that there's not too much mathematics involved, and most of the concepts are common to us, like foreign exchange, money, demand and supply of money. So I think all of us are familiar with these topics, at least on the surface. So today we will try to learn the mechanisms behind and study these topics from a more academic angle. And some of you have studied engineering, computer science, so I think you don't have any problem with the mathematics and the little bit of algebra we have, which is really very simple in this course, probably compared to the research methodology course. Okay, so we can have a look at I think all of you had a look at the syllabus. It's monetary economics, so classic topics: demand, supply of money, interest rate, the monetary policy, which is usually if you study economics, bachelor or even master's level, usually there is a dedicated course about monetary policy. So it's a lot to say about this topic. So how central banks controls the supply of money through different strategies, including mainly interest rates, in order to reach the goal they have. And then we will see many central banks have one goal, but some of them have more than one. So in the next lesson, we will talk a little bit more about monetary policy. So for today, I want to cover all the topics in the PDFs. So today I have sent to you an email. You can find basically lecture 1 to 6 uploaded on a link I sent to you. So there are some notes and some highlightings I made just to simplify the study of these 6 PDFs. So we don't really need to finish today. I want to save some time at the end of this lesson for some questions, and then I will try to answer live, but probably, I don't know, if we have a lot of questions, I will take some time to write down the answer in a separate email for later. So as I said, the aim is to cover at least 5, if not all of these lectures today. And then for the next, we can discuss about this. That's my plan, but we don't really need to stick to that. My goal is to help you, so we can discuss a different approach. What I had in mind for the next lesson is to cover the readings. So the instructor of the course prepared 3 different readings. One is about, actually, sorry, 4. One is about Bitcoin. It's actually a pretty old paper, 2016. And 3 are about the monetary policy of 3 different central banks. We have Far East Asia banks, the US Fed, and European Central Bank. So these are more like executive papers for the US Congress, 2 of them, and 1 is a more academic paper. So pretty enjoyable to read, not too much technical. And for the last meeting, which will be in 2 weeks, we can do some practice. So today I mentioned the mock exam, just because the provider of this course, they call it exam, but I think it's really similar to the assignments that you will have to solve later. So 4 questions. We can do this together in the last meetings, if you agree. And then we have another 2 practice things we can do. We have some general questions about the readings that we will do next week. So one about Bitcoin, Fed, East Asia, foreign exchange rate policy, and European Central Bank. And then we have the assignment. So the deadline for the assignment has been postponed to November, end of November. So if we have time, we can also discuss about this, at least have an outline of the answers. Then all of you, the goal is be sure that all of you understood how to answer these. And then once we have an outline of the answer of those 13 questions, you can write it by yourself, and then later I can check. Okay, so do you have any questions? Otherwise, we can start. And I think for today we can for now I think we can have 1 hour first break in 1 hour, and then if we're not too tired, 1 more session until the end. And I think you can raise your hands virtually in the chat, or you can just unmute microphone and call me in time. So I think we can skip the introduction. We already talked a lot about the course, and we can move to the first topic. So the first topic, it's money and money market. So how many of you have taken a similar course in the past, or in general are familiar with what's money market, what's the definition of money, interest rate, central banks, even simply by reading the news. Are you familiar with this concept? So I just want to know how much time should I spend on this, because it's quite basic. Okay, someone is here. Okay, 9 students. Hello.
Hi.
Yes. Hello. Hi.
Hello. Hi. It's Catherine here.
Yes. So first of all, the meeting is recorded. I'm sorry if who arrived late has missed the first part, but so far I just discuss about the course, what's the plan for these 3 meetings, a little bit of background about me, and we still haven't started the actual lesson. So I was asking if any of you have taken a similar course at university, or is familiar with like central banks policies, why central banks controlling interest rates, why do we have money? So the reason we have, okay, money is just a human invention, right? It's an artifact that we don't need to have that potentially, but through the history, people started to store like precious metals like gold and silver, and then at some point it was inconvenient to carry those heavy and dangerous metals, so they started to write on piece of papers the value that the note actually has, and is guaranteed by gold. So that's how in the past, even 3,000 years before Christ, this already happened. That's why right now we have banknotes. The only reason we have banknotes is because we don't want to carry gold that is usually stored into like central banks. Most of the gold is actually stored in the American Central Bank, even if it belongs to China or other countries. And why we did that? Because we needed a smarter way to trade. So before money, people used to exchange goods. The problem with that is that you need to find someone that has compatible, mutually compatible needs, and also sometimes you don't want to give up your entire goods. Let's say you have a house, you don't want to trade your house, you just need a little bit of the value of that house to purchase maybe some food. So money are useful because they are divisible, and also they work as a unit of accounting. So we can price things against this banknote or whatever can be nowadays bank a record in a database, and it's easy and fast to transfer. So we don't need anymore to deal with the exchange of goods, even though this still happens sometimes. So the first reason we have money is medium of exchange. So we produce, usually we have one job and we need to trade some of our time, basically, because we work, we're paid, and we have a limited amount of time, so we need to use some of our wealth to purchase what we need. And how do we exchange our salary basically against goods? Is through money. So first thing that we need money for as a medium of exchange, as a unit of accounts. In general, before money, you could say that, I don't know, this cow was worth 100 stones, 200 shells, whatever, 2 dogs. So there was no clear unit of accounting. Nowadays, everything is measured against one currency, or in international open economy, more than one currency. So medium of exchange, unit of account, and store of value. Store of value is a little bit more difficult because, again, it depends on the intrinsic, not on the intrinsic value, but it depends on the perceived value of the money. So this is more related to what I was talking about before. The gold that originally was stored into banks, because you want to keep these banknotes only if it guarantees you that in the future, while you will need it to purchase things, it will still retain the value. So we need it as a medium of exchange, unit of account, and store of value. Nowadays, if a medium or whatever, some new invention like cryptocurrency does not have all these three features, is not commonly considered money. So there's a debate if Bitcoins and cryptocurrencies are money or not. The direction seems to be that they're not money, they're more like an asset. So, but this debate is still ongoing. For sure, cryptocurrencies, they can be used as a medium of exchange, even though they have some costs, or may not be liquid as legal money. As a unit of account, usually that's not the case. Unit of account, it means that something is priced exclusively in Bitcoin. So once people start to price things in cryptocurrencies, then the values of the money is linked and attached to real goods. So it helps also the money to retain a value. So cryptocurrencies nowadays are not used as units of account, and they're really volatile. It means the price fluctuates a lot, so they cannot be considered as a mean for storing value and wealth. So this is the definition of money. In a system without currencies, people had to find someone that had the same, as I said before, a mutual need. That's not always the case. Also, a lot of goods are not divisible. And definition of terms and trade, that's a different story. Also, nowadays, money, a main problem, I mean, not a main, but the difficulties that we have when we trade using money is still the definition of terms of trade. You want to be paid immediately in 90 days. So definition of terms of trade is not something specifically of barter, but also of trade executed with money. Yes, as I said before, a banknote has a face value, an intrinsic value. So I was reading today the euro 2 euros coins has an intrinsic value of 10 cents. So they're made of metal, so they have intrinsic value. They have a face value, of course. In the past, they were linked to gold. We will see what happened later. And then there are different types of money. We will see this in details in the next chapter. Of course, there are money written in a bank account, coins, banknotes, term deposits, and cryptocurrencies, which is a little bit more not clear what it is. So as I said before, cryptocurrencies can be potentially, virtually in the future, can be considered as money, but right now it's not, for the reason I said before. And I think most of us familiar with cryptocurrencies, at least we know that they're private, in the sense they're not issued by governments. That's why governments tend to ban them and make them illegal, because they compete with the legal currency. So central banks don't want to lose the control of the supply of money for obvious reasons that we will see later. Cryptocurrencies are global. They're produced online and shared, decentralized, because they the way that this technology works, it's basically it's a sort of software distributed in the laptop computers of people that want to take part in these projects, and all of them are coordinated through an algorithm, and they all together work simultaneously to basically verify the transactions that are done by these cryptocurrencies. That's why they're considered very safe, because you don't, in order to crack the code or whatever, to copy, whatever, replicate a number on a cryptocurrency account, like in a fraudulent way, you have to somehow convince all the people that are running this algorithm to do what you want. So it's very important. It's possible, but it's highly improbable that all together change the code at the right time and basically crack this system. So it's decentralized, it's global, it's private, and it's digital. Basically, there's no actual physical cryptocurrency. As I said before, they're highly volatile. They behave more like an asset, like for instance, a stock or a current bond. So the price is really, really volatile. So most of the cryptocurrencies dropped by 60, even more % since the beginning of the year. So they cannot be used as a store of value for sure, at least now. And we have seen it's a factual thing, they're not used as a unit of account. So some companies offer the possibility to pay by cryptocurrencies, like Tesla, for instance, but it's very different because the price of Tesla, it's in USD. If you want to buy it, then you can convert you can send your cryptocurrencies, but the price is still in USD. So you have to exchange your USD, buy the cryptocurrencies, and then you pay how much cryptocurrency depends on the exchange rate of the cryptocurrency to the USD. So that's why USD, it's a strong currency, because it's somehow linked to actual goods. So I know that this car cost $500,000, and I know that the value of the USD somehow related to this good. So cryptocurrencies are not used as a unit of account, they're just used as a mean of payment somehow, because the price is still in USD. So in other words, they will never say, no, you cannot pay in USD. So as long as this is the case, cryptocurrencies cannot be considered a unit of account. It's just a second optional mean of payment that you can have, but they will never refuse if you pay in USD. And they're very volatile. So that's the main reason right now. They can become less volatile, but we will see that that's probably not enough, because a lot of governments are not happy, because as we have seen before, they're private. So I personally, I'm not very optimistic. I don't think government will. And then we are actually seeing this in many countries. Governments are actually fighting, or at least they're trying to regulate them. So once this sector will be regulated, then cryptocurrencies will be yes, a private provider of money, but it has to go has to be compliant with the central bank policy. So it will be private, but somehow it will not retain the freedom of decision that the developers of algorithms behind cryptocurrency have now. And other reasons why governments are not happy is, of course, money laundering and tax evasion, terrorism. They're actually not anonymous, because of course there is an identity behind the wallet. So what is anonymous is the transaction itself. So you don't know who you're trading, you're exchanging your crypto with, but the broker or the digital wallet actually has your identity. So there have been cases in US of, actually there are many companies starting this business now, doing an investigation, like financial fraud investigation in cryptocurrencies. And there have been many successful cases. So they managed to figure out who were actually exchanging cryptocurrencies in a context of in an illegal criminal context. So they managed to, it's doable. That's factual. They made it. So it's anonymous. The transaction is anonymous, but of course, if the government suspect that transaction involves some tax evasion, they can do investigation and then figure out actually the identity of the wallet owners. Another problem right now is the consumption of energy. Many governments, they're not happy with the consumption of energy that cryptocurrency requires. So they only want to trade, and I think this is actually what's going to happen in the US. Recently, I heard that the policymaker, they said, you need to prove that your cryptos have been mined in a green, sustainable way. So there are companies that are starting to like acquire lands like in Iceland or in other places of the world where you can produce energy, renewable energy, and use that renewable energy to mine cryptocurrencies. So it's a big problem right now if a company do transactions. I mean, not right now, but in the near future, people are expected to be. This is expected to be a problem if a company in a company transaction there are some cryptocurrencies produced with not green energy. So yes, consume a lot of energy, but it can be done in a green way. So it's one of the disadvantages that seems to be right now seems to be less of an issue compared to 1 year ago. The main problem is, of course, that they're challenging the supply of money, so central banks are not happy with that. And another problem is financial stability. We have seen some cryptocurrencies collapsing. Also, companies like Voyager, they provide, it's a listed public company in US, they provided some financial service related to cryptocurrencies. They drop in values almost to zero. So it's a problem for the financial system and of course consumers. That's the final taxpayer usually is the one that eventually has to pay the consequences. Governments don't pay taxes, so that's what happened right now. What's happening right now. So there are many disadvantages. Some of them can be overcome, but still a big debate. So now we move more to the traditional definition of money. And as you can see, there's no space for cryptocurrency. So this is the traditional definition of money you can find in academic textbook. Let me zoom in a little bit. So M0, 1, 2, and 3. So M1 includes M0, M2 includes M1, M3 includes M2. So moving from M0 to M3, you have a larger group of types of money. However, the liquidity is the highest for M0 and the lowest for M3. So liquidity means the ability of basically use the money in a transaction without additional costs and without long waiting time. So fiduciary money means banknotes and coins. So they have the highest level of liquidity. They are they're ready usable. You can use them immediately, no costs. And then we have scriptural money. Scriptural basically means digital money. So that's the money in bank accounts, like not deposits, not like short-term deposits or investment, just bank accounts, like let's say your current or saving bank accounts. So M1 contains banknotes and coins and scriptural money. M2 and M3 are deposits. So these are term deposits. It means they're not immediately, they cannot immediately be liquid. You have to call your bank or log in on your home banking and then close the position. Then maybe after a few days, maybe after a few hours, these money are transferred to your bank, the current bank account. So short-term deposits, 1 month, 3 months, up to 2 years, M2. And M3, long-term deposits, maturity more than 2 years. So I think it's not in this slide, but I can, okay, it's here, it's actually here. I've written down the numbers. So as probably some of you already guessed, the banknotes and coins, they just represent a very small part. So that's the Eurozone. M0 is only 5%. So yes, so sorry, M0 is actually 9%, represent 9% of the total money in the economy. Then we have M1 is 67%, so the majority, so the jump from 9 to 67 is the bank money. So the money in the bank accounts, which is 58. Right, so we have 9% fiduciary money, and then we have 67, so this is 58, and this is 9. And then the deposits, less than 2 years maturity, they're not so much, 28. And deposits with maturity longer than 2 years are only 5%. So this is 95, and this is 100. So this number here, the gap is 28%, and the gap here is 5%. So as you can see, the largest amount is here, 58% of the total money. It's in bank accounts. And savings, we only have 33, basically. The remaining part, the complement to 100, which is also 28 plus 5%. This is the Eurozone. Of course, maybe it depends on how well developed is the banking sector. Some economies, more banknotes are used. Perhaps in Hong Kong, people don't use so much cash, banknotes and coins compared to Europe. I think this number here may be higher and this smaller. And maybe in developing countries, M0 is actually probably 40%, 50%. Yes, so everything that, so M0, M1, M2, M3, these are definition of different types of money, and we're talking about money market. So money market is about assets or like secure financial instruments, let's say, that can be comparable to bank account, bank savings, and also term deposits. Everything else, capital market, bonds, stocks, everything that is not money market is capital market. So for instance, even though we have seen that M3 contains, we have seen that M3 contains maturity longer than 2 years. For instance, you can have bank account deposit with maturity 5 years. This is money market. On the other hand, you can have like a T-bill, which is a 1 month US government, US Treasury bond. Even if the maturity is shorter than 2 years, that's a different instrument. It's a security, it's a bond, it's issued, and it's very different. So that's the capital market instrument. It's a bond, and here we have money market instruments. So the maturity is not the main criteria. The main criteria is the contract itself. So if the contract resembles money, let's say a simple short-term deposit or long-term deposit, it's money. If the contract resembles a bond, there is an issuer, there is a face value, there are coupons, that's a different type of instrument. So the definition is contractual. So it's not really, does not really depend on the term, on the maturity. Okay, so we have money market and capital market. Yes, people exchange financial asset against money. So there is a direction, usually money flow, wealth, let's say not money, wealth, flows from money market to financial market, capital market, and also other way around. So people can exchange the stock or the bond they have with money. So they liquidate their position in the capital market, and they are paid they're transferred some money to their bank account or into their brokerage account. So you can sell your asset in the capital market and receive a money market instrument, or other way around. So they're interconnected, and everybody, included like consumers, like physical people, can access these markets, but also banks, like commercial banks and central banks, very active. Actually, the retail sector, which is non-institutional, let's say retail sectors, in the money market is actually a very small part. Capital market, it depends on the countries. It can be as big as maybe 20–30% in US. But in the money market, the main players are, of course, central banks and commercial banks. They exchange money reserves between them, and also between commercial banks, and also from commercial banks to central banks. We will see this later. Okay, so the demand of money usually comes from companies or individuals, and they may need money for many different reasons. For, as we saw before, to store value, to exchange. However, the supply, so the institution that creates money, which is the supply side, doesn't have a plurality of individuals. So let's say within one economy, within one state, or even within one monetary union, like in Europe, money are supplied only by central banks. That's not entirely correct, because we will see there is a mechanism through according to which the commercial banks can create money as well, but the majority of money is created by central bank. So the supply of money is from central bank, and the demand, which is the other side, come from our households, individuals, and companies. So central bank has a monopoly of the production of money, and what they produce is M1. Let's go back. So they produce M0, banknotes and coins, and M1, so the scriptural money. Commercial banks can also create money. We will see the mechanism, but basically, I can tell you already the main channel through which money is created by commercial banks is through loans. So they can issue loans to the economy, which is actually literally creating money from nothing. They have to keep some of the deposit they have into reserves, but they can use. They don't need to deposit all the money into the reserve. They only have to deposit a part, so they can use the rest of this money to issue loans, and then we will see the mechanism is actually very interesting. And that's how money is created, through loans. And if loans are created at a faster rate, then they are paid back. There is an increment of money in the economy. If the economy pays back these loans faster than the rate or the new ones are created, then there's a shrinkage of money. If everything else is kept constant. So money can be created by central banks and by commercial banks. Most of the money is created by central banks, however. And the other side, we have demand, households and companies. So they need money for investments mainly, and for exchange. This is a very simple description of interest rates. I think everybody's familiar. So a positive interest rate R means that the side of the transaction that is providing money at some point in time in the future will be paid back the principal, which is the face value, the initial money that has been lent, plus an interest. So let's say you lend 1,000, and then the interest rate is 10%. Then at the end of this borrowing operation, which is in the contract, the provider of capital will be paid back 1,000 plus 10% of 1,000, which is 100. So, and this mathematical formulation basically applies to both sides. So if you lend or if you borrow, there is either a negative or plus sign in front of the operation, but the amount of money in this operation at the beginning, T0, at time, T1, the time of the payback, is the same. So instead of using the borrowing example, you can, for instance, think of a case where you go to the bank, you deposit some money, your principal, and then the bank gives you a regular, let's say, monthly or annual interest. So when you go to withdraw your money in the future, you will be paid back principal plus an interest. Interest rate can also be negative, we have seen in recent years, but for most of the history and now is positive. In Europe, has been negative longer than US, but in general, maybe we can talk about this later, it's not part of the course, but the interest rate is usually positive. And another important variable is the inflation. Nowadays, it's actually a very prominent topic right now. So because there is a time delay between the time the contract is concluded, so that the initial money is transferred and the time the money is paid back, something can happen in the middle, which is the inflation. So the inflation is defined as the general increase of price in the economy. So let's say you have a 2% interest rate today. You put in your bank 2,000, and then in 1 year you will go to the bank, you will receive 2,040. However, during this year, the general price, the prices generally increased by 3%. So in order to buy the same basket of goods that was costing 2,000 1 year ago, now you have to pay 2,060. So $40 or 40 euros that you have gained through the interest rate are not enough to compensate the increase of price of this basket of good you want to buy. So the real interest rate is the nominal one minus inflation. So that's why in general, during periods of high inflation, also the nominal interest rate increases, because the preferences of the economy, of the economic agents, they don't change so much. They're quite constant. So people either want to receive the same real interest rate, no matter what's the inflation regime right now, or company has to do an investment. They don't want to pay more. They think this was the real interest rate we were paying. So if now there is inflation, that's not my problem, central bank problem. So when inflation goes up, nominal interest rate usually follows, because otherwise the agents, people, companies in the economy would either stop deposit money in the bank, or stop borrowing. So there is a trade-off between nominal interest rate and inflation. However, this is an identity. So this is real. This is true no matter what. These are all exogenous variables. So basically, this is true in any case. No matter how the interest rate is defined, no matter how the inflation is defined, the real interest rate is the nominal one minus inflation. So in this example, the real interest rate is minus 1%, because I put some money in the bank, but now in order to buy what I wanted to buy before, it cost me 20 euros more. So I have to find somewhere else it's 20 euros. So the operation is negative, minus 20. Okay, I think we can finish this set of slides. So yes, so as I said before, but we will see this in details later. So just as an introduction to the next topic, the interest rate, the nominal one, follows somehow the inflation. So inflation is observed by central banks, and then central banks act. They take decision, and they set or change, they control the interest rate in order to keep down the inflation, or increase the inflation, or keep the price or the inflation stable. So we will see what are the goals of central banks later, but central banks can influence interest rates because they need to reach their goals. So how many interest rates central banks can influence? Usually 3 interest rates. So the first interest rate is the one that central banks pay to commercial banks. So central banks are like the banks of commercial banks. So we consumers, we go to, we interact with banks, commercial banks. Commercial banks, they interact among them, like us, private people, but also they have their own bank, which is the central bank. So banks, commercial banks, like HSBC, for instance, they can deposit money into the central bank. They may have to also, or they have to, it depends. So if they have excess, usually central banks ask commercial banks to keep some of some reserves into their central banks, and these reserves is usually is a percentage of the asset of the bank. So the goal is financial stability. So let's say a bank is growing a lot, has a lot of deposit, is lending a lot of money, however, is lending too much. So now the assets of this bank are too many compared to the little capital that this bank has. So to avoid financial instability, which can be bankruptcy of this bank or liquidity problem for this bank, central banks ask commercial banks to keep a percentage of their assets or their capital into central bank's account. So central banks have one account with each commercial bank, and commercial banks, they have to immediately complain with the requirements. So central banks monitors commercial banks constantly. They see the balance sheet. They say your assets are too many. You have to put some reserves into central bank for stability. So some commercial banks, they have to keep some reserves at the respective central banks. However, they can also deposit excess reserves. Let's say they only have to deposit 100. However, they want to deposit 200. So on the excess reserve, the 100 on top of the capital requirement they have to keep as a reserve, commercial banks can earn an interest rate. So the first interest rate is the one paid by central bank to commercial banks on the excess reserves they keep at the central bank. Then there is a second interest rate. So this is usually for overnight deposit, overnight to 1 week deposit, and it's the same that that all the banks have to pay. So this is a policy. These are policy interest rate. So the central banks publish these interest rates, and they are the same for each bank. So these interest rates don't have to do anything with the financial risk involved in the operation. It's just the policy. So you have to, the commercial bank have to deposit some money in the bank. They can earn a little bit of interest on the excess reserve, but then they can also borrowing some money from central banks, and they pay the second interest rate on this operation. However, this borrowing, they have a maturity of 1 night to 7 days usually. Central banks, they have also use a collateral, which means an asset or a set of assets. So let's say HSBC needs some liquidity for the next week. So what they do, they go to the central bank, the Hong Kong Monetary Authority. They say we need 1 billion Hong Kong dollars. So they send some of maybe HSBC equity or some other assets they hold. So they deposit this asset as a collateral into the central bank, and that central bank issued a loan to HSBC with 1 night or 7 days maturity, and HSBC pays an interest on this operation. So that's the second interest. The third interest is very similar, it's basically identical, but it's for operation of with maturity higher than 1 week, up to 3 months. So usually every day, banks have to comply with the reserve overnight. So at the end of the day, they check the balance sheet, the assets they have. Okay, we have to deposit this much to the Hong Kong Monetary Authority. They have to do it. If they want to deposit a little bit more, they earn interest rates. If the bank, before the end of the day, they figure out they need some liquidity, then they can, if the liquidity is needed for only 1 night or 7 days, they can send some collateral to the central bank and receive some money and pay interest on this operation. Similar case, if the bank needs liquidity for more than 1 week, up to 3 months, they pay a little bit more, but the operation is basically similar. Why they need, sometimes they need money overnight, because they don't have enough liquidity to to be compliant with the reserve they have to keep at the central bank. So they have to keep, let's say today, before midnight, they have to send some money to the central bank as a reserve. And that's mandatory, but they don't have enough cash right now because they issue, I don't know, for whatever reason. They can send some collaterals. The central bank lend the money the bank needs overnight just to be compliant with the reserve, and then they pay the interest rate on this operation. So these are the policy interest rate. These are set by the governor or the governing committee of the central banks, and they are policy interest rate. It means they're the same for each commercial bank. So all the banks are treated the same way, and this is one channel through the monetary policy is exerted. As I said before, the supply of money, so the quantity of money on the x-axis, you have quantity of money, and here you have the interest rate. So if the interest rate decreases, so we move this direction, borrowing money is cheaper. So I'm expecting the quantity of money in the economy to increase, right? It's like money is like any other good, like Apple. If they cost less, people demand more. However, the supply is fixed by, is rigid, is not elastic, it's rigid. So it's constant and it's decided, fixed by the central bank. Through the intersection of the supply and demand, we find the equilibrium. So that's the quantity in the economy, and the interest rate of the central bank is this one. So let's say the central bank, let's say the central bank increases the interest rate. So let's say move the interest rate here. What happens? We have a new line. The intersection is here. So the economy still consists of the same people. So same people, same companies. The demand depends on the economy. So it cannot change overnight. So the mind of people, decision makers in companies or consumers cannot change altogether overnight. However, the central bank, they have regular meetings, and usually once per month they have the monetary policy committee, and they decide the interest rate. So if overnight they increase the interest rate, now we have a new equilibrium here. So people demand less money. So the quantity of money in the economy will move here, and the interest rate will be higher. Yes. So the important things here to understand is that the supply of money is fixed, is decided by the central bank. Why? Because it's the only institution that can create money. So it's the central bank that decides how much money has to be in the economy. However, the economy has preferences. They say, if the interest rate is so high, let's say here, I will demand only this money. If the interest rate goes down to here, I will demand this money. So the economy has a set of preferences. The central bank has a rigid, non-elastic supply of money. So from the intersection of supply and demand, we have equilibrium. And equilibrium is basically, it's a couple of values. The first one is the quantity of money, and the second is the interest rate. So at any given time in the economy, you take a snapshot, you see, you can count the money in the economy, the banknotes and coins, the banking accounts, the savings, 2 years and over 2 years savings. And then you can also read on the central bank website, the policy rate. So that's actually the real world. That's what happened. Every point in time, we have an interest rate, monetary policy interest rate, and quantity of money in the economy. However, this can move to the right, to the left. The central bank can decide the quantity of money and also the interest rate. Okay, I think. Yes, now we will see in the next set of slides, we will see why the demand of money has this shape. So the next set of slides is about the demand of money, and the one after that is about supply of money. Yes, I think we can take a quick break here. Maybe 10 minutes. We can start at 8:23. I'll try to go faster, but you can stop me anytime. And I started slow because I don't know if you were familiar with this or not. And also these concepts at the beginning are important. But now I will try to go faster. So yeah, we can take a break and come back in 10 minutes. And you can, if you have any questions, you can think about that now. And if you want to stay here and ask me some questions, I'm available. Otherwise, you can take a break.
So I have a question.
Yes.
But maybe not really related to the slide you are teaching about the dissertation. What if I have already the formula, but then I have to use the existing series to support it, right? Or maybe I come up with something new, you know. But I do have the formula in mathematics.
Okay.
But I don't know how to explain it or to form it as a series or relate to.
But where did you get the formula from? In a paper, or you just figure it out yourself?
I figure it out, but
okay. So yeah, you're free to use it. You should try to. So I'm not sure I understood the question. The question is, how do I provide motivation? How do I justify this formula?
No. So the thing is, the formula is there, and then if you tested it, it's working. But the problem is, you need some existing series to support it, and then
you mean data.
You expand it with something new, but based on something already existed, right?
Yes. So yes.
What if that's like a, but it's somehow relate to psychology, also somehow relate to physics. I don't know how to explain it right now, but you know.
But by series, you mean data, like time series data? You need some data to test your formula.
No, data I have, formula I have, but the problem, for example, like it's a financial things, a quantitative something. But the thing is, you need to have existing literature review to support it, right? So
yes.
So the thing is, by literature review, it might not exist for the.
It's fine. I mean, you can have a totally new original work, or you can expand, like build on top of something existing. You know, you can do like an incremental research. So it can be something, can be the same formula used with different data, can be the same formula used in a different problem. Like,
okay,
like a methodology.
How you name it then? Like, I don't know how to just explain.
How do you name the formula?
Sorry?
The question is, how do you name the formula?
Formula is very straightforward. it has also like a visual chartism result you can see like right away. But the thing is some mathematically makes sense, but you cannot literally explain how.
Okay, so is it the problem is it's difficult to explain it, to make people understand.
Yeah, what is it?
It's like you came up with this formula, is clear in your mind, to you it makes sense. Yes, so we write and try to publish because other people can read it, understand. So that's very important point. So
yes,
yes, the output of a research should be understandable, and hopefully people should be able to replicate the results. So
yeah.
However, it depends. Okay, this depends on the field of study. Like usually economics and finance paper really long, like 40, 50 pages, for instance. They explain a lot. In some other studies, like fields like management science or even computer science, papers are really short, like 10, 12 pages. So they don't explain much. If you have a mathematical formulation, that's already enough. There's nothing more clear than mathematical formula, right? There's no space for ambiguity. It's very understandable. So it depends where you want to publish. So if it's a finance paper, you have to explain everything, because people are not expected, like editors and readers of the Journal of Finance, they're not expected to have a super strong background in algebra and mathematics. So you have to explain in words what you're doing. But it depends. It really depends. If what is this for? Is for the course research methodology?
Yes, research is finance somehow is.
So if it's an assignment or a dissertation, yes, has to be as clear as possible. Yes, so you should try to explain the intuition behind. So why I have used this formulation? What are the variables? Why I have picked this variable in this formulation? What happened? You can do some what if analysis or sensitivity study. So like we will see here later, actually. So you can say, I'm expecting this to happen if this variable increases. So give a flavor of the formula. You shouldn't be too technical, because the readers may not be too technical, but you should be able to make them understand what's behind. So here we have a demand of real money demand is a positive function. So it's a positive function of salary or income. So you can say if salary income increase, I'm expecting this formula to give me a higher output. It's negatively related to bond returns. So if bond returns increases, I'm expecting the real demand of real money to decrease. So you should make people understand. So what are the mechanisms behind, without being too technical. But it's difficult to answer because I haven't seen the formula. So
right.
For instance, some formulas can be very clearly explained with plots and graphs. Some other more they don't have a natural representation. For instance, like I don't know, a formula like an integral that calculates.
The thing is, how I found it is also like accidentally. Like you get the graphs and you see it very exactly clear, but yeah. So then the thing is exactly like somehow like the Fibonacci numbers that they do, like the rabbits you know, every year how it increases, and then the ratio somehow is close to this portion, right? Somehow like this, and then so
it's an empirical study. So you came up with this formula and you are documenting that this formula works, and you are
Right.
providing evidences in favor of this method. You don't need to have a theory behind.
Oh, you
right?
don't have to then. Okay.
No. It you know, like in asset pricing, if you wanna explain price of a stock, you can have a theoretical model behind, or it can be just an empirical evidence.
Okay.
You know, you don't need to have a necessarily theoretical background to publish a paper or a dissertation, as long as the empirical methodology has given you enough evidences that is robust and it works. So
okay.
yes, so if you have this formula and then you provide enough evidences that it works, you don't need to theoretical explanation.
But the thing is, yeah.
Yes.
But you need literature. I'm sorry. Yeah, please.
Please stop.
But you need the literature review, right? Which means because our
yes.
Yeah, our she advisor for dissertation, Dr. Helen, she was saying that we have to search like existing ones, like journals to support our things, and then to do the literature review. But then I cannot. How?
So my advice is keep searching better. Probably there's something related. But if it's really novel, like a novelty discovery, you will not find anything related. So you can still write financial literature about the context of the problem, right? You're using this. What is that technical analysis, for instance?
Yes, somehow like this.
Yes. So you can find a literature review about technical analysis.
Oh, okay.
Like time series methods applied in technical analysis or indicators. You can write about the problem, because you're using this is a novel methodology. There's nothing close to it, but you are still using this methodology for a problem, not just for. So you can write literature review about this problem, and then about this particular asset. Probably you're doing this with Forex or cryptocurrencies. So you can write about this market, this type of product, and then you can write about the closest. It may be really novel, but there should be something which is the closest methodology to it, right? So you mentioned Fibonacci series, for instance. So you can write about that and fill the gap. So this is my new novel methodology. I believe the closest one is this Fibonacci, and my methodology has this advantage and this disadvantage compared to it. You know, you can write about the problem, about the context in terms of type of assets, and then the similar methodology. Okay.
Thank you so much.
But I think you can keep searching. It's at the beginning, it's not easy to become familiar with finding academic papers and topics. There are so many. I know it's frustrating, but if you search well, you will find something similar.
Okay.
This is an advice in general for also other students. My advice that also has been given to me is to find 1 or 2, 3, maybe 5 journals that constantly write about your topic of research, and then have a look at the most recent papers. So you can take a lot of hints to what is the state of art right now, because of course they all have literature review. So you may found a paper written 5 years ago, which may not be updated. So have a look at the journals that constantly publish in your field, and then have a look at the abstracts of maybe the last 3-5 issues, numbers, and then you will, if you find some keywords in the name of the research paper, relates to your project, then have a look at the literature review. Because of course, the most recent literature review is the best, is the most comprehensive. So starting from the most recent thing is helpful instead of randomly searching for a similar paper, maybe written 10 years ago, maybe 5 years ago. Yeah, that's my advice.
Okay, thank you.
Welcome. Okay, I think we can go back. We have 9 students, very good. So next topic should be money supply, but I prefer to do money demand first. It makes more sense to me because we were not central banks. So when we think about money and we approach this topic, we think from the point of view of consumers or companies. So let's talk about money demand. And I think it's also easier to understand because we're all familiar with interest rate, loans, borrowing money, and so on. On the other hand, none of us has been a central banker, I guess, and we're not very familiar with what's happening inside the decision-making of central banks. So money demand. We need money, as I said before, for different reasons, as a medium of exchange, as a value store value, and as a unit of account. So transaction basically means using money to exchange goods and services. And the purchase power we have is what determines the amount of goods and services that we can buy. So the income, either of an individual or of the entire economy, which is the GDP, the income of a person or the income of an economy, and ultimately somehow is the driving force behind how much we can trade, how much goods and services can be involved in our transactions. So the more income we have, the higher demand of money we have. So the higher is the income, the higher is the demand of money. And however, let's talk about banknotes and coins, which is easier. So we can put our income in the capital market, bonds and stocks, or we can keep it as money. So money usually does not pay you. Let's talk about coins and banknotes, or even bank accounts. Usually they don't pay you interest, or the interest is really small, it's irrelevant, right? So the opportunity cost of money is what we are losing by keeping our wealth in a money financial product compared to invest it into a security. So the opportunity cost of money is another determinant factor of the demand of money. What is our, let's say, it's general return rate of the market, for instance, or equity, bonds, whatever. That's not important. Whatever it is, if it increases, the demand of money decreases. So let's say we receive our salary and we can keep it as money when we're not receiving any return. However, we can, if the market, like the stock market, is doing really well, we want to put most of our income in the stock market. If we don't do that, we're giving up this return rate. So that's the opportunity cost. So higher income, higher demand of money, higher return rate, higher opportunity cost or return rate of other products, lower demand of money. You can stop me anytime if it's not clear. So as a transaction, this is true as a transaction. So we need money to do some transaction. We will keep more money for transaction if our income is higher, and we will keep less money as a for transactions if opportunity costs is higher. The same thing for precaution purposes. So we don't know what's going to happen tomorrow. We want to be safe. We want to keep some of our wealth into money reserves. For the same reasons we have just discussed, this amount of money we keep as a precaution purpose is higher if our income is higher, but also is smaller if the opportunity cost, which is the return we're giving up by keeping wealthy money, is smaller if this opportunity cost is higher. So yes, we want to be safe, want to keep some money in reserves, but not too much if this will imply that we are giving up a lot of returns from the stock market, for instance. So demand of money for transaction and demand of money for precaution purposes are basically driven by the same factors. Then we have a new approach. So I think this was Milton Friedman, a Nobel Prize in the 70s. He started to study, analyze the role of money in a context of portfolio decisions. So we want to diversify our investments, and money can be now considered as an investment as well. The definition of money, the role of money doesn't really change. This is more like a abstract model or mental model that investors have. So they allocate the wealth between stocks, bonds, but also money. So there is a demand of money as assets in portfolios, and we saw that this is actually true. Asset managers, investment companies, they actively decide how much to keep as cash. They call it cash, it's actually money, not necessarily cash, can be like short-term deposit. So they actively decide how much of the portfolio allocating into cash. So now there is also demand of cash as a diversification tool. And then again, this demand is lower if the opportunity cost is higher. Nobody wants to keep so much money in cash, so much wealth in cash or money, if they're losing the chance, opportunity to invest maybe, I don't know, in Tesla or some other security stocks that perform really well. So in conclusion, the demand is the sum of demand of money, sum of transaction, money, precautions, purposes, money, and also portfolio allocation, so storing of wealth as money in general, and also as a transaction, but also actively as a portfolio allocation, define the total amount of money in the economy. So usually households, they care about transaction and storage of value, so for precautionary reasons. Investment companies, they don't care much about transaction. They focus more on this term here. So I1 plus I2 plus I3 is the total demand of money, and they all share the same drivers. So higher income, either as a person or as a company, implies higher demand of money. Higher opportunity cost implies lower demand of money. So now we move to the Fisher trade equation. So that's an identity. It's an identity. It means this is always true. So mathematically it should be like this. So this is always true. So no matter how the price or the quantity of money or the velocity of money or the number of transactions on the market are calculated or recorded, let's say, this is always true. So it's just a human artifact to analyze reality. So we can say, because this is always true, we can do a what if analysis. So what happens if M increases? So in order to this to be always true, we can either decrease V, or we can increase P, or we can decrease T. We will see this later. So just remember, this is always true. And what does it tell us? It tells us that the quantity of money, the money supply, times the velocity of money, which is the number of transactions that a monetary unit does in, let's say, 1 year. So it's a bit difficult as a concept, but if you think that the money is limited, is not infinite, and there is a finite number of transactions, then you can calculate the velocity of money. It's a sort of a proxy of how often people exchange money. So the quantity of money, the total amount of quantity of money in the economy, and times the velocity of money, which is the number of transactions made per monetary unit. Monetary unit means 1 Hong Kong dollars, for instance. So how often 1 year this Hong Kong dollar is exchanged. So quantity of money times velocity, it's always equal to the average price of a transaction times the number of a transaction on the market. So this is just something created by scholars to do simple interpretation of the reality, and it's always true. Just by definition, there's nothing difficult to understand. We assume that this is always true. So now we can play. Let's say if we increase M, let's say the quantity of money increases, in order to be equal to the average price of a transaction times the number of transactions on the market, then because M has increased, V has to increase as well. So in other words, P times T can be seen as the GDP, the real GDP. So you have the average price of a transaction times the number of a transaction. This gives you the GDP. So if we want to do this little simple what if analysis, we can say, because the right hand side has to be the same, right? The GDP, the real GDP is this one, it's the same. Now, if we increase the quantity of money, what will happen? Because the numerator, because M has increased, then V has to decrease. Has to decrease in order to keep this identity true. So it means more money in the economy, but the GDP is the same. Probably means that people exchange less often. Or we can say, what happens if the average price of the transaction increases? So that this is very similar to inflation. So there are still the same number of transactions in the market. However, the prices now go up. So in order to this be the same, we can explain an increase of the right-hand side in two ways. We can say, well, the quantity of money can increase. So the GDP has increased, there's inflation. It means that probably too much money has been created. Or we can say the quantity of money is the same, but how come the GDP is higher? Simply, this same amount of money has been circulated faster within the economy to justify a higher GDP now. So, yeah, as I said, P, yeah, because the number of transactions in the market is difficult to record. Usually we can replace it with P times Y, which is the nominal GDP. So real GDP multiplied by the price level. So let's say, very simple case, an economy that only produce chicken. So P is the number of chicken, and Y is the real GDP, which is the number of chicken, and P is the price level of one chicken. So if the economy has produced, I don't know, 10 chicken, 100 chicken, each of them cost 10, then we have 1,000 of GDP. And then we can so if this number increase, we can explain this increase in two ways. More money has been created, or in other words, you can say more money has to be created in order to produce more, or simply higher velocity, which is a proxy of, somehow nowadays is used as a proxy of inflation. So we will see this, there should be a slide about this. So a few months ago in US, they were monitoring the velocity of money to guess the inflation. So the Federal Reserve has a statistic for the velocity. You can see there was a spike in velocity. I don't exactly know the methodology, how do they measure it, but the Fisher equation is useful in this case because, you know, the amount of money is the same. They haven't increased it. Now there is a higher velocity. So the real GDP cannot really change much so the velocity has increased in 1 month. The GDP in 1 month cannot change too much. So the economy, even the next month, cannot produce twice as much as the previous month. So why is pretty constant? The quantity of money was constant. The Fed found out an increase in velocity. How can we explain it? There should be a following increase in price. So that's an example how to use the Fisher trade equation. So we observe an increase in velocity, and then if we assume that GDP is constant, we can expect an increase in price. So inflation, right? So that's a simple model. I think this was published in the 70s, so it's a pretty traditional. No, sorry, 1911 Fisher trade equation. 1911, so it's 111 years old, and it's a simple identity of that links the monetary economy to the real economy in a country. So there is an example. So 100 chicken sold at 10%, $10. So P times T, total number of euros exchange. So 100 chicken times 10. Quantity of money is 50. So we can, for instance, using Fisher equation, we can calculate the velocity. So that's the same formula here, right? We just move m to the denominator, right-hand side. So can be used for many things. One of the usage is to estimate the velocity. Let's say another example. The Fed, instead of measuring the velocity, they want to estimate. So they cannot observe velocity. They only see the prices. They know the money in the economy, and then they know the number of transaction. So now they can estimate, they can calculate the velocity. So if price increases, velocity should increase. If the prices are the same but there are more transaction, the GDP will grow, of course, but with a constant amount of money, it means velocity should also increase. Or you can say the GDP, the real GDP is the same, but now we decrease the quantity of money. So the central bank reduced the money in the economy. Because the denominator decreases, V must increase. So makes sense. We produce the same, there are less money in the economy, it means velocity must increase. So this money has to circulate faster. So why do we study that? It's a very old model. It's an identity. So it doesn't really need to be verified in the real world. It's more like a conceptual abstract artifact. it's always true. So you can do this simple what if analysis, but also can be probably a little bit more sophisticated version than this, can be used by central banks to estimate these variables. So M is known. M, if we go back to definition of quantity of money, it's really known. I mean, there's nothing to be estimated. The central bank knows how much coins and banknotes are in the economy. They can call the commercial banks and say, ask how much money do you have in the deposits. They know exactly, for the same reason they can ask banks how much short-term deposit they have. So the quantity of money is known in an economy. We will see later how prices are calculated. Usually central banks, they have a basket of goods, and then every month they literally send people to shops and see how much things cost so they can estimate P. Or they can also estimate the GDP, which is P times Y. So in this case, they know the GDP, they know M, they can estimate velocity. Let's say they found a way to, perhaps they ask bank, the tables, all the transactions they make, so they can count the velocity, and they want to estimate the prices. So M is constant. They know T, and they know V, and they can calculate P. So it's a simple conceptual model to do what-if analysis, but also can be used operatively by central banks. Probably they have a little bit more sophisticated version, but this is still true. And here we have a real economy example. Yes, then we have the QTM, which is a neoclassic model. So this is from the 70s, this one. It's quantitative theory of money. So this model has been developed by like Friedman and some other neoclassic economists from Chicago, it's called Chicago School. And of course, the money supply is exogenous. So central banks, exogenous means something that is not affected by the system itself, something like alien. So the central bank decide exogenously money supply. So it's a decision taken by the central bank committee. It's not function of anything else. They can decide exogenously. So the monetary authorities decide the money supply. The money demand is expressed by people. So we saw it before, is a curve. So people say in their mind, if the interest rate goes up, I will not subscribe the mortgage. If the interest rate will go down like this much, yes, I will take this mortgage. So they actually have a set of we all have set of preferences in this mind. It's a demand. So like for an apple, I would not buy an apple for $1,000. I would buy it for $10, $20. Maybe for $1, I would buy more compared to the case when they cost $5. So in our mind, we have like this sort of demand. So the higher the price, the less we demand. Central bank supply is exogenous. Money demand, it's decided by economic agents, by different different factors. So as we saw before, P times Y is the real GDP. So price times the output, so the real GDP. And K is the share of income that agents like companies or individuals hold in form of money. So the demand of money, again, if the income increases, increases as well. If the prices increases because of inflation, we demand more money because we actually need more banknotes, or even, we need, things are more expensive, we need more money to buy it. And then also we demand more if we keep our wealth, our income, more in money compared than in capital markets. So K is a percentage that goes from 0 to 100%. So I can keep in money, I don't know, I think people usually 20, maybe 20% of the 30% of the income of the GDP, for instance, if we think of an economy. So 20% of the GDP of an economy, it's not, let's say, invested in other assets like stocks or bonds or physical assets. There is kept as money. So K is how much an agent hold in the form of money. P is the price, Y is the real, the output of the economy. So P times Y is the real GDP. So this is the formula of the demand of money. And there is also a modern version. So remember, before I told you, so that's the neoclassic school. And then we saw Friedman decided, I mean, he figured out that money can also be part of the portfolio asset discussion. So there is a new version of this formula that is called the modern version of QTM, which takes in the role of bonds and equity. So F, it's a function. We don't really know. Actually, each economy has a different function. However, the real demand, so that's the real demand of money, quantity of money demanded divided by the general level of price. So that's the real quantity of money demanded. It's a positive function of the income. It's negative function of the bond return. So M is the return of money. B is the return on bonds, and E is the return on income, or on equity, sorry. That's the inflation, and U other preferences. So we can call this, you know, that's the excess. That's the excess return of bond over return of money. So if a bond pays 5% and a similar same maturity money deposit pays 1%, this is 4%. If the equity market pays 10% and money 1%, that's 9%. So that's the opportunity cost of bond. So if we the opportunity cost of money with respect to bonds. So if the returns on bonds increases, then we want to keep less of our wealth income in the form of money. So the relation is negative. Also for equity, if the equity pays much more than the money return, then we want to invest in equity. So we demand less money. We demand less money means we saw it before, M0, M1, M2, M3 means we deposit less into bank accounts. That's not necessarily coins or banknotes for transaction or even for precaution purposes. It's also M2 and M3, which is the term deposit. So we deposit less in bank accounts. We either invest more in bonds than equity if they offer higher interest rate. Inflation, so that's negative as well. So if the inflation increases and is not compensated by the return that money gives me, we saw it before. The return on money was 2%, equity 3%. So this is negative. So 3 minus 2 is positive. So it means the inflation is higher than the money rate, interest rate. So we will keep less money, less wealth, less income in form of money. What people usually do, they would rather buy. So if they expect inflation, they will use the money they have to buy things. So when you buy something, you are not demanding money. You actually lose the property of the money. You're getting rid of the money you have. You give it out. So in exchange, you buy goods and services that you think you expect next day, next month will be more expensive. So higher inflation, less demand of money. So money demand divided by prices is the real demand of money. Okay, so this is demand side, and now we go to the supply. Any questions about this? Okay. Okay, so money supply is a bit more complicated because this belongs to the realm of central banks. So this is what central banks do. And most of us were not familiar before this course or before studying economics. So it's interesting to know how central banks decide. First of all, how they decide what's the amount of money the economy needs. Why they choose this amount of money? What's the goal of central bank? So what are the goals of central banks? And based on their goals, they decide the amount of money in the economy. How do they influence? How do they actually change the amount of money in the economy? That's the monetary policy. So we will see what are the goals of central banks, how do they choose the right amount of money, and how do they actually implement the change of the amount of money? How do they increase it? They don't throw banknotes on the street. That would be a way to do that, but it's not efficient. So there are ways that central banks can use to increment and reduce the amount of money in the economy to meet the goals they have. So in the past, as we knew, the amount of money was linked to quantity of gold. So you have a relation 1-to-1 gold to money. So central banks couldn't change the amount of money without changing the quantity of gold they kept in their banks, in the reserves. So if they wanted to increase the quantity of money, they actually had to physically buy gold from other central banks. So that was the past. That's no longer the case because there was no room for monetary policy. Central banks couldn't react to inflation by changing quantity of money because they were not able to perhaps find gold. So central banks were not independent. They were pretty much useless at that time. They just guaranteed that banknotes were not forged, counterfeit, and then monitor the financial systems, but they didn't really have much to do with the monetary policy. Nowadays, this link between quantity and money, it doesn't exist anymore. We will see what happened in 1971 after Bretton Woods and so on. Nowadays, central banks can indirectly control the quantity of money through commercial banks and through monetary policy in general. So how does this happen? First thing, we need to understand the balance sheet of a central bank. I think all of us we're familiar with balance sheet. We know we have liabilities on one side and assets. So liabilities basically things that the bank has to eventually, ultimately, even if it don't necessarily need to happen, they have to refund, to pay back. So they have to give some values to banknotes holder. They have to give money back to the commercial banks that deposit some reserve into the central bank, and then eventually they have to pay back the usually commercial banks or government that initially funded with capitals the central bank. How the central banks use the liabilities? They have some assets, so they can keep some foreign assets. We will see why. Usually to for the balance, for the trade balance. So countries trade with foreign countries. So commercial banks in country A needs to exchange local currency with foreign currency in order to trade with abroad. Then in some cases, that's not the case for instance, Hong Kong or the European Central Bank, but in some cases like the Fed in US and also Bank of England, two famous examples, they can actually fund government. So governments say we have a deficit this year, and central bank literally print money to cover the loss of the government. And then they also have central bank operations. So this is related to monetary policy. These are the reserves that the banks keep or give back to commercial banks in order to influence the quantity of money in the economy, other items, anything else. Okay. So as I said, foreign assets for trade purpose. It's very simple. If you want to buy something from Japan, you need to pay in Japan currency, yen. So you go to your commercial bank, eventually your commercial bank exchange local currency with a central bank that keeps foreign reserves. And then the agent, the household, or the company now have foreign currency to trade with abroad. They're used to impact the foreign exchange. Some economies, like Hong Kong, for instance, the central bank keeps USD reserves in order to influence the exchange rate between the Hong Kong dollars and the USD dollars. So, and actually in Hong Kong, for each Hong Kong dollar, there's also one USD in the central bank. We will see this later. It's a particular case of peg exchange rate. But in general, it doesn't need to be pegged. It means like a fixed exchange rate. It can be a floating exchange rate, like in Europe, for instance. The European Central Bank sometimes, occasionally, try to influence the exchange rate, for instance, between euros and USD by what they usually do. They buy USD from commercial banks in Europe and then keep it in their reserves. So when the central bank buy foreign currency from the economy, from commercial banks, and put them in their balance sheet, so now this currency is somehow hidden from the economy. So it's now more rare than before. So what happens that commercial banks, in order to have this foreign currency that they need to trade with abroad, for instance, they are willing to pay a higher price in terms of local currency against foreign currency. So central banks increase and decrease foreign exchange reserves in order to influence the exchange rate. We will see this later. There is a set of slides about this. And then also they need to pay interest on foreign debt. For instance, the China Central Treasury, so the Chinese government, through the Treasury, they invested a lot in the US public debt. So they invested a lot of money. They regularly buy US government bonds. How they do that? They need to have some USD, right? And the US government has to pay interest. So, for instance, they have, if it's a bond that pays regularly every month, so every month the US government has to send some USD dollars to the Chinese Treasury that has invested in the US public debt. US in this case can print dollars, but let's say another country like, I don't know, Japan, invests in US debt as well. So now the US government can buy, I don't know, Japanese yen, convert them into dollars to pay back the interest on the US public debt held by the Japanese institutions. So these are the three main reasons why central banks have foreign assets, and it's this part here. Then, as I said, that's not the case in most of the economies, but like in the US and in UK, Bank of England, they can actually finance the government directly by issuing money. Then there are some operations. As I said, these are the monetary policy. What does it mean? So the central banks, in order to meet the goals they have, they keep the reserves at a certain level that they believe it's optimal. And then occasionally they purchase or sell assets from the economy to inject money in the economy. For instance, if they want to increase the money base in the economy, they force commercial banks to agree to sell their assets to the central bank in exchange of cash. So now commercial banks are injected with a lot of cash, and they can use this excess cash they have now to give loans and create scriptural, which is M1, scriptural money in the economy. Or instead of purchase asset or sale asset, central bank can also change the reserve requirements or the three interest rates that we saw before. So there's some operation that central banks do that involves monetary policy, and as a consequence, this has an impact on the balance sheet. So this part of the balance sheet can increase or decrease based on the fact that bank is purchase or selling reserves or changing the requirements or issuing some money by, for instance, lowering their interest rate. So a lot of banks come to the central bank, commercial banks come to the central bank asking, now you have reduced the interest rate, I want more money. I will pay you the interest. So the central bank issue some money through this mechanism, but let's see the details later. So the point here is just to understand the asset and liabilities. Banknote, so these are actually the M1, M2, and M3. Sorry, M1 and M0 and M1. Then there's some operational capital here, foreign asset, government balances, and this part is the monetary policy, basically. So let's say, just an example, let's say, as I said before, US wants to create some, from nothing, just create some USD dollars to buy a foreign currency. So what they do when they create a new tranche of USD, they basically, let's say, increment this block. So now we have some new USD here, and this corresponds to an increased reserve. So the increased reserve is fictitious. It doesn't really exist. They literally write, we have increased our capital by this, and then we're holding this capital in as a USD reserve. Then what they do, they exchange this reserve in the foreign exchange market with foreign assets, and now they have a larger portion of foreign assets. That's what they do. But not all the central banks can do that. Like, for instance, European Central Bank cannot do this type of things. Why the Fed can do that? Because there is always a very high demand of USD. So even if they create USD from literally from nothing, there is always a high demand because it's the currency of the global trade. So the risk that you have when you create money from nothing like that is that you devaluate your currency against other currencies and also create inflation at home. But because even if they create new money, this newly created amount of dollars is, there is always some countries in high demand of dollars, either because they don't have a stable currency or because they need to trade, because most of the global trade, even let's say between Russia and Europe, is all often done in USD, for instance. So there is always high demand of USD dollars. That's why they create literally money from nothing. But technically, every bank can do that. Some banks cannot because it's in the regulation of the bank itself. Some other banks cannot do that because they're not, the currency that is not that strong to justify this new creation from nothing. So the economic agent will notice. Let's say I don't know, a small country bank create like suddenly so much new money. The foreign exchange players, they will notice it. How come this cannot, so much money cannot be created by nothing? I mean, cannot be increased, cannot be backed by an increase of GDP like overnight like that. So it should be an issue. This should be an issue of like fresh money created out of nothing. So okay, now we figure out how much money is created, and then we like mechanically adjust the exchange rate. So we have this amount of euros and this amount of small country currency. The small country currency increased the monetary base by this much. So it means that from the ratio between these two values, you can determine the new exchange rate. So it's a mechanical thing. And now players in the forex market, they will only trade against this currency at this newly determined price. So what happens is that all the transaction will be recorded at this new lower exchange rate. And what the consequence of this central bank action is that they actually immediately devaluated the currency against euro, for instance, in this example. So only US can do this right now. So create fresh money from nothing, because this balance sheet is basically backed by the global economy, at least the global trade that happens in USD. Okay, so how new money enters the economy? So this answers the question how the central bank increased the monetary base. I partially answered these questions, but let's see the details. So banknotes enters the economy, so M0, through commercial banks. Like where can you get ultimately cash and banknotes from the ATM? So it's through commercial bank. So now we go one step back up, how commercial bank can increase the money. So as I said, commercial banks have some deposit requirements, and they also have some free reserves, which is what they can deposit at the central bank on top they are required to do by law. So commercial bank can deposit more money in the central bank. And what does it mean? It means that every time monies are deposited from commercial bank to central bank, these money are subtracted from the economy. So they are in the central bank, which is somehow a neutral player. So now the sum of deposit in all the commercial banks is lower. So the banknotes in circulation are probably the same, but the deposit of people at the banks are the same. But now banks have lower reserves. So they literally hold less M1. So on the other hand, they can deposit less reserves into the central bank. So because the central banks perhaps reduce the requirements. So what happens is that when central banks reduce the requirements, that commercial banks, that the deposit of the, so when central bank reduce the requirements of deposit that commercial banks have to keep in the central bank, basically now the commercial banks are freed to take back some of the reserves they had in the commercial bank, at the central banks, and now suddenly they have more reserves in their balance sheet, and they can use them because not using money is not convenient, so they have to find a way to use this newly fresh reserve they had back from the central bank. So what they usually do, they put them back into the economy, either by giving loans or basically loans. That's how they create money. And we will see the mechanics of this channel of creation in a minute. It's not important. So as I said, we briefly touched this topic for creation of money through purchase assets. Central bank can buy assets from commercial banks, usually bonds. So usually what happens, commercial banks buy the government treasury bonds every month. So they have a lot of these bonds, which is not money. They are capital market instruments. So banks has these bonds in their balance sheet. And now the central bank, for whatever reason, they decided that they have to increase the money base in the economy. So they call the commercial banks and say, sell me these bonds, and in exchange, I'll give you money, like cash, basically, money. So now commercial bank agreed, they have this new fresh injection of money, because on this money, if they keep them in the balance sheet, they're not earning anything. Before they were earning interest on the bonds, but now they sent this bond, they sold this bond to the commercial bank, central bank. Now these commercial banks have some money and they don't know how to use them. They have to find a way. So what they usually do, traditional business of money, they lend this money. So now this money from central bank has reached the commercial bank in exchange of bonds. Now the commercial banks have a lot of this fresh money. What they do, they give loans to the economy. So this is how money eventually reach the economy and increases. So these loans end up in some people's bank accounts. So it will be M1, banks accounts, basically. So scriptural money, digital money, whatever you call it, money in banks account of people who receive loans. So now we have, if we do the sum of all these people and companies in the economy plus the banks, we have an increased monetary base. And this increases the size of the balance sheet of the central bank, of course. Because why? Because now they have more assets. So they have created some money. Another way, instead of actually purchase assets from banks, they can lower the requirements. So as I said before, commercial banks, for monetary financial stability reason, based on the size of the bank, they have to keep some reserves at the central bank, something like 8-10%, for instance. Now the central bank say the economy needs some stimulus. The GDP is slowing. So what they do, say, okay, instead of keep 8 or 10%, let's only keep 5%. Commercial banks only keep 5% of your assets, of your asset dimension as a reserve in the commercial bank. So now, before was 10%, now is only 5%. So the central bank will give back to commercial banks this excess reserve. So commercial bank can do two things. They can keep the free reserves at the central bank and earning the second interest, or they can say, I don't want any interest from you, commercial bank, central bank. I think I can use this money more fruitfully in the economy. So give me back the excess reserve I have. So now the commercial bank has more reserve. They can use them to issue some loans, lending. So again, through the lowering of the reserve requirements, more money base has been created in the economy. Same thing works by increasing the reserve. So if the inflation is really high, the central bank wants to slow down inflation, so it wants to decrease the money base in the economy. They ask commercial banks to deposit more reserves. So now commercial banks have less money available for loans because they have to be compliant with the central bank requirements. So they will probably reduce loans. So and then eventually the money base will shrink. And then the third instrument central banks have is the interest rate. So as we saw before, there are three types of interest rates. And in a nutshell, this interest rate is what commercial banks pay to receive loans from the central bank. So commercial banks are like people. They need some liquidity sometimes. So instead of going to another commercial bank, they can go to the central banks and they can say, I'm HSBC, so I need some liquidity. And then the central bank says, I'll give you as much, usually it's literally as much money as you want. You just have to pay me the interest rate. Usually that's the second interest rate if this liquidity is for less than 1 week, or they have to pay the third interest rate if it's more than 1 week up to 3 months. So they refinance, central bank refinance commercial banks, which in turn have to pay this interest rate to the central bank. So it's very simple to understand that if this interest rate is high, commercial banks ask less money to central bank. If the interest rate is lower, commercial bank ask more money. So purchase or sales of asset from and to commercial bank, change, increase or decrease of the reserves requirements of commercial banks at the central bank, and interest rates. So these are the three monetary policy instruments. So now we talk about the actual mechanism of creation of money through loans. So in all these examples, I said commercial banks receive more. They receive some cash from central banks, either in terms of less reserve requirements or more liquidity in exchange of asset purchase from the central bank. So how these higher reserve in commercial banks can be translated in creation of money, so through loans. So the key idea is the following one. So let's say we have a system. So how to read this in columns. So here we have reserve rate, which is how much, it's a percentage between 0 and 100. So this means how much of the asset a bank has must be kept in the central bank. So let's say 10%. So 10% of the deposit, let's say deposit that the bank has, must be kept in a reserve at the central bank. So that's the reserve rate. And money multiplier, it's something that tells you how much money can be created from one unit of reserve. So let's say we don't have any bank. Money multiplier is 1. So one deposit made at the bank, that $1 can only be used as a $1. So if there are no banks, I receive 1. I have 1 from individual A. I can only lend this 1 to another individual. I cannot create anything. The same story if now we have banks, but banks have to keep all the reserve at the central bank. So basically, people go to the bank, deposit their money, And 100% of the deposited money must be kept at the central bank. So the money multiplier is 1. However, if the reserve rate is, let's say, 10%, which means of all the deposit that a commercial bank has, only 10% must be put in the central bank. The other 90% can be used freely by the bank. In this case, the money multiplier would be 1 divided by 10%, which is 10. That means $1 of reserve at the central bank can create up to $10 of money base in the economy. And then, yeah, let's see this later. So we have an example here. So that's the case of 100% reserve. So that's the balance sheet of a bank. People bring their money to the bank, 1,000 deposit. The bank cannot do much. Only take this 1,000 and put it in the central bank. So now the bank is basically without any liquidity, cannot issue loans, cannot do anything. However, let's say the reserve rate, sorry, the reserve rate is 20%, which means of 1,000 liabilities that people deposited at HSBC, only 200 must be kept at the Hong Kong Monetary Authority, the central bank. These other 800 can be used freely by the bank, right? So the only requirement by law that the bank has is to, at the end of the day, the bank has to tell the central bank how much deposits they have, 1,000, and the central bank must receive before midnight 200 as a reserve to be compliant with the monetary authority. Now the bank has 800, and it's free to use these 800 as she wants. So what the bank does the next day? The next day, the bank used these 800 to issue loans. So how much money we have now in the economy? 1,800. So 1,000 are deposit of people, and 800 have been issued as loans. So they ended up in someone else or company bank account. So now we have 1,800 in the economy. Money supply, right? Is it clear? So that's a pretty, it's mechanical. Conceptually, the first time I studied this thing 10 years ago, it took me a while, but it's quite mechanical. There are only two things. There's a fact, so that's a factual thing. People actually brought into their banks 1,000. At the end of the day, the bank has to deposit to the central bank 200. And the central bank doesn't care what the bank does with the remaining 800. So the remaining 800 can be used, can be deposited at the bank, at the central bank. Then the money in circulation will be only 1,000. Can be used by the bank in any other way. So if the bank decides to create loans, then these loans will end up in another bank accounts. It can be company A receive these loans. So now we have deposit from people, and then we have company B or company A with 800 just received as loans. So the total amount of money supplying the economy is 1,800. So let's say next day, I mean, yes, that's the same case, right? We have 800, 20% the central bank loans. In this case, the total amount of money in the economy will be 1,440. Money supply. Yes. Let's say the bank next day increase instead of 20% increase the reserves to 50%, then the commercial bank has to keep at the central bank 500, can only issue 500 as loans. So the money supply would be 1,500. So that's how the partial reserves changes the money supply. Let's make one more step. Let's say the bank also has some government bonds here. So there are some bonds, they cannot be used. The bank can just keep it and wait to receive coupons every month. But now the central bank says, you don't need them. You don't need to have those bonds. The economy needs some money. So the central bank buys these bonds and injects some reserves. So here there will be some cash now, right? What the bank does with this cash? Before, the bank was earning some interest from the bonds. Now, if the bank doesn't find a way to use this cash, it's wasting money, right? That's a opportunity cost of money. So what it decides to do is to issue loans. So now we have deposits, we have some loans, and then we have some more new loans that's coming from the purchase of bonds in exchange of liquidity injected from the central bank into this commercial bank. So reserve is one way to do monetary policy. Asset purchase and asset sale, second way. And the third way is as I said before, the interest rate. So this bank wants to increase the liquidity, just simply call the central bank and saying, central bank, send me some money, I will pay you the policy rate. Now bank has some cash here in the assets and can convert it into loans. Or the central bank, let's say the bank is doing this, but now the central bank say the economy is growing too fast. There is a risk of inflation. So now I'm going to increase the interest rate. So this bank will think twice before refinancing itself from the central bank. So instead of asking for some cash and pay the interest, we'll just not do that, because the interest the commercial bank has to pay back to the central bank is too high now. So there will be less free cash in the assets of this bank to be used as loans. So this will mean a lower increase or even a shrinkage of the monetary supply. As I said before, one more thing to be considered: the monetary supply can only increase if the rate of creation of new loans is faster or higher than the payback of these loans. So if at some point the bank has slowed down issuing loans and a lot of people are coming to pay back and extinguish these loans, now there will be less money in the economy, because virtually there is no more loans, only this deposit. So the channel of creation of money from monetary policy of central banks to real economy really goes through loans. And what happened during the financial crisis, we will see this in details. There is a lesson that this chain of reaction actually stopped here, especially in Europe. European banks, the interest rate was zero. So European banks accumulated so much cash, virtually infinite amount of cash for free from European Central Bank, but they didn't use that cash to issue loans. So they inflated their balance sheet, but those money never actually reached the economy, because the economy was in recession and the banks considered issuing loans too risky. So there was no way for the central bank to physically increase the monetary supply if not through the loans. So that's Milton Friedman said, you can bring your horse to the lake, but you cannot force it to drink. So that's what happened. European Central Bank tried the best to basically give infinite amount of money for free to commercial banks, but those money, that money never actually has been transformed into loans to the economy. So the monetary supply, which is, we know what is in bank accounts of companies and households, did not increase, because could have only increased if those companies would have received loans, but that simply didn't happen. So that's a very important mechanism to understand. It's a commercial bank money creation. Some more examples here. Yes. Yeah, so as you can see, the reserve is 20%, so the money multiplier is 5. So if you do 1 over 20%, then you have 5. That's the money multiplier, and we can see the example here. So first period we receive 1,000, then 800, then 640. So in the end we have like 5,000 actual deposits. Because we only have to take 20% of the deposit and bring it, put it into the central bank, then after the first period we can increase the loans by 800, and then the next day we receive some new 800 deposit, we can increase the loans by 640 and put this into the reserves, and so on. So in the end, we have created the money that's circulating the economy is 5,000 plus 4,000, so 9,000. So these 4,000s here, I mean, that's we can even stop here the first 3 records. All these loans, this is money created from commercial banks, right? So this is just an example. So they show that of 5,000 deposited in total, only 20% went to commercial bank, to the central bank. So we increase loans by 4,000, and then we also have deposits. This means 9,000 in total. And increase the reserve only by 1,000. So the money in the economy, this one is monetary supply, is 5,000, and the reserve is 1,000. So the ratio is 5,000 to 1,000 is actually 5, which is equal to 1. Sorry, very difficult to read. So the monetary supply is 5,000. So this means 5,000 divided by 1,000 in the reserve is equal to 5, which is the money multiplier, which is the ratio between the money supply and the reserve at the central bank. So the reserves at the central bank is 1,000, and we know that this is equal to 1 over 20%. So for each dollars in the central bank reserves, there are 5 dollars circulating in the economy. We can even, you can even just focus on the first line. 1,000 deposit, increase in loans, reserved 2,000. So if you do total money in the economy, sorry, increase in deposit 1,000 divided by reserves, it's 5. So you for each dollars in the central bank, then you have 5 dollars in the deposits, and then you have a net creation of 800. So here you have for each dollar in the reserve, you have $5 in the bank accounts, and you have created 4,000. So in other words, for each dollar in the central bank reserve, you have $4 of newly created money in circulation for a total of 9,000. So let's keep the reserve rate constant to 20%. Then what's the total amount in the economy dynamically? So the first year you have this amount of money. Then in the second year, you have the net, so 80%, which is what you don't need to put at the central bank, times D1. And this is D2. And then in D3, what you have? You have basically what you had at the end of the previous year minus what you need to put in the bank. So now you have D3. So if you replace D1 here and D2, this thing into here, you have something that is called geometric series. And if you let this go to infinite, basically saying, giving this reserve rate of 20% in the long term, starting from $1, let's say $1, how much money after this long term, which is infinite number of iterations or periods, there will be in the economy? It's this one. So it's basically someone likes mathematics, basically the limit should be something like that. So that's the limit of infinite sum of it's a geometric series. So it's the sum from 0 to infinite of basically this term to the power of 1, 2, 3, and so on. So it's geometric series. And then the result is this one. So it means that after a long number of iterations in the long term, if I start from an amount of deposit, initial deposit, D1, with a 20% deposit rate, reserve rate, in the long term in the economy, there will be 1 over 20%, which is 5, the initial deposits. So after long term, which means many iterations, many periods, there will be 1 over 0.2, which is equal to 5 times the initial deposit, D1, in the economy. That's a deposit multiplier, what we have seen now. It's a numeric example, very simple. Okay, the same model can be made a little bit more complicated, not too much, if we introduce T. Yeah, what is T? T is the currency ratio. So the currency ratio is how much economics agent hold in fiduciary money, which is bank account, basically. M1, so this is M1. Banknotes and coins and bank accounts. So, you know, if people, sorry, this is actually M1. What is fiduciary money? It's bank account, basically. So it's M1 minus coins and banknotes. So strictly bank accounts. So basically M1 minus and banknotes. It makes sense, right? Now the model not only has the reserve rate, but also the fiduciary money. So more money people, higher is T, which means higher is T, which means how much fixed proportion of the deposit that the economic agents hold in fiduciary money. So highest is T, lower will be the multiplier, because people, sorry, made a mistake. People will not deposit this money into banks. So banknotes and coins will not be part of the multiplier. So higher, so what is T? T is the currency ratio, which means how much wealth or how much ratio of total money people and companies have is held into banknotes and coins. So higher is T, smaller will be the multiplier. Makes sense. We learned that in the long term, the lower the reserve rate, the higher is the money created. So from initial deposit, D1, in the long term, the money created will be, if reserve rate is 20%, will be 5 times the initial deposit. So 1,000 deposit can be transformed into 5,000. However, if instead of D1, this deposit only a part of T, I mean, if part of this wealth, instead of being deposited, is kept as coins and banknotes. Coins and banknotes cannot be used to give loans. So loans are given only as a scriptural money, as a bank account money. So the more people hold as coins and banknotes, which is T, the lower will be the multiplier. So given the same amount of initial deposit, if now we take some of this money and hold them as banknotes and coins, the amount of money that the banks, in terms of money created through loans, can create will be smaller. So the bank multiplier will be smaller for higher value of T. So the multiplier decreases for all values of T. So for positive values of T, anytime at least a little bit of money is held in coins and banknotes, they're not available in commercial banks' balance sheet. They cannot use to be given out as loans. Yes, so that's the example I said before. So if money can only be created if loans are created faster than reimbursement. So let's say we have 1,800 money in the economy, and now someone said, I want to pay back my credit. So this is no longer credit. This will become cash. So the company goes to the bank and pay back the debt. So now they have reserves. And how much money we have in the economy? We have no credit right now and only 1,000. So the central banks, if the goal of central bank in this case is to create money to stimulate the economy and increase prices, what can they do? They can try to induce commercial banks to issue more loans than people are paying back. So they can lower the interest rate or purchase assets of commercial banks, or can reduce bank reserves. So now banks are happy to have borrow some money from the central bank and use the money to create loans. On the other way around, central bank can increase interest rate. Now commercial banks will not find it convenient to borrow money from central bank to give out as loans. Also, central bank can sell assets. So they ask commercial banks to buy some treasury bond that central bank is keeping in their balance sheet in exchange of cash. So now a lot of cash goes out from commercial bank into central bank to buy these bonds. So now commercial bank has less cash. They also find it difficult to borrow money from central bank. They may also have been required to increase their reserves they have at the central bank. So all these three monetary policy techniques will reduce the reserve the bank has, commercial bank has. So now they cannot create new loans. So the money supply will be reduced. Okay, this is just the example. Okay, this was the most difficult part of the lesson. There's a money supply, money demand. I think of the course. This is the most difficult part of the course. And we started a little bit late, half an hour late. I was hoping to maybe cover the financial crisis, but no problem, because we covered the four more important and most difficult topics. So the next one is the financial crisis. That's quite simple, it's not much technical. And it's very useful to recap the things we have discussed today. All the things I've been talking about today, they have been used by either the Fed or European Central Bank to issue the financial crisis. So you can have a look at I will explain this next time, but if you want, you can have a read of the slides, and you will find correspondence of the monetary policy option that central banks have and that have been used. And then also monetary policy, pretty much just a recap of what I've said. Now, I talk a lot about the examples and the monetary policy techniques banks have. And the very last one is the exchange rate. So the exchange rate also is very simple and is disconnected from monetary policy. So I think in 1 hour next week, even less, we can cover these topics. So we have financial crisis, foreign exchange, and a very short recap of monetary policy. Just this one. Yes, what's the objective, what they can do, what's the relationship with monetary base and inflation. It's positive, of course, from the Fisher equation. What is inflation? What is deflation? Very simple definitions. What are the goals of central banks? So I will use 1 hour to finish this 4 set of slides. The focus will be on the financial crisis, which is the interesting thing. And foreign exchange is simple. This one is just a recap. And then we will use the 2 remaining hours next week I will highlight and put some notes on these 4 readings. We have Bitcoin as money, and then we have 3 different readings, 1 for each central bank. So we have the American Central Bank, US Fed. We have the European Central Bank. And we have the East Asia foreign exchange rate policy. So we have 3 examples of different central banks. All of them, they have different goals. So we see them we will see them in the second 2 hours of next week, and Bitcoin also. And then for the last meeting, we can answer the questions based on these readings that I have just mentioned. Bitcoin as money, Federal Reserve, East Asia foreign exchange rate policy, and European Central Bank. We can do that's the mock exam. Basically, it's the assignment, similar to the assignment, and then we can also have a look at the assignment itself.
So will the assignment that you have on the screen now be the assignment that we submit at the end of the module?
I think so. I think so. Unless the instructors do not update the website, that's the only one I found.
Okay, thank you.
So I will talk to Charles, and we can actually ask the course provider. But from the course material, that's the only assignment we have.
Okay.
Yeah.
Thank you.
I hope it
the
was
4 articles for next week.
Yes.
Okay.
Yes. The Bitcoin one is a bit old. A lot of things happened since 2014 for Bitcoin. It's a totally different thing right now. Yes, but the questions are still relevant.
Yes.
So
yeah.
Number 4 is very different. The scenario is very different for question 4. Number 1 is pretty much the same as Bitcoin. Hasn't changed. I mean, in the algorithm, at least the environment and the users have changed a lot. Yes.
Okay, thank you.
Thank you. I can stay longer if anyone has some questions. So I will save again the slides I've used today, and I will upload them on the Google Drive again. So I've taken a few new notes. So you can still access the folder from the same link I've sent to you today. Someone asked me, and I enabled the consent to transcript my voice. I don't know exactly where the transcript will end up. So if I will figure it out when I close this meeting, when I end the meeting, probably a file will be generated, and then I will share it with you. For the recordings will be on it's already recorded, should be on the school server, and I will give you the link tomorrow. Okay, so if we don't have any other questions, okay, someone is in the chat. Okay, thank you, Tina. Yes, feel free to send me some feedback. So if you didn't like something, or you prefer me to go slower, or anything, any advice is appreciated. So as I said, the topics today were the most difficult, so don't worry too much. We can go back and see them again. Next lesson will be easier. Okay, thank you. All right. Someone else in the chat. Okay, good. See you next week. Thank you. Have a nice week, nice weekend. See you. Bye-bye.